Okay. All right, good. And so let's just go ahead and let's open up the chapter 5 material. Pretty straightforward set of material, guys. I think if you had to rate in terms of difficulty, I would say chapter 4A, 4B was probably, the more difficult material, though for you guys, I doubt it's that difficult. Chapter 5, I think, would be maybe one of the lighter chapters we've had thus far. So let's just go ahead, though, and let's take a look at some of this. And I'm hoping that my machine won't make me go through that process. Okay, but one can hope and dream for things and have them not come true. I'm still waiting for my hair to grow back. Okay, so let's go ahead and take a look. I'm not really, although sometimes I have dreams that it grew back. But anyway, let me get out of this. You know the procedure now. You've seen this enough times. Very annoying, I realize, but I don't know how not to have it do this. Seems like I have to end PowerPoint that way so that I can open the same file again. I already had open. Put my machine in tablet mode. Okay. I have no idea. Okay. Okay. So let's just go ahead and let's take a look at these slides for chapter 5. Okay. And basically, we're going to be looking at most of the discussion is going to be about a particular project in the capital project fund. And then we're going to at the same time see how we would record that using full accrual accounting at the government wide level. Again, my point now that you've heard several times, and I'm sure you're maybe probably tired of hearing, is we would generally convert from the individual fund statements to the full accrual statements. So, taking a look, when we deal with the capital project fund and when we dealing with capital assets, we're talking about long-term fixed type assets, land, building, construction work in progress, machinery, equipment, longer term durable items, including infrastructure assets, for example, roads, streets, bridges, that sort of thing. And then we're not going to say too much about it, but there could be intangibles such as patents, easements, water rights. They could be held by the governmental entity. Okay. Now, the funding for these things can come from a variety of sources. Often, in what we're going to contemplate today, the source of funds for a capital project will come from the issuance of tax supported bonds. Sometimes, I hope this continues into the future, but the way the federal government is acting these days, sometimes I wonder if that's going to continue. But it has been the case that the federal government and sometimes the state government will give monies for construction of assets meeting certain requirements, et cetera. Often we'll see funds being transferred from maybe the general fund over to other funds like the capital project fund for the construction. Gifts from individuals or organizations. And I don't know, when I've looked at this one, I'm like, does this happen a lot? I'm thinking probably not. Does the city get gifts from individuals in the form of fixed assets like trucks or equipment of some sort? Tina, you're saying yeah?
I don't know if that counts like books. We got a lot of books and donation as a donation to the libraries.
Oh, books. Oh, okay. I thought we were saying boats at first. Books. Okay. Yeah, I can see that. There probably wouldn't be much value to that, I would imagine. They probably don't even make a journal entry for that, or do they? Would there be an accounting for that? I don't know.
That's a good question. I don't know.
Yeah.
Carmen might know better.
Yeah. Okay. All right. But that's a good example. Books, those sort of things, but probably wouldn't be a journal entry for that since, it's kind of hard to put a value on a book. You see all these books sitting behind my shoulder here. I should probably throw about half of those away because they're duplicates. It looks like, wow, John, you read all those books. Well, I've read some of them. I keep them up there because I never know what I'm going to have to reference. But I should throw probably half of them away anyway. But I've got little notations made in different versions of the same book over the years, and I don't want to lose the notation, so I keep the book. But special assessments. Special assessments is when we tax individuals that will benefit directly from the capital project. For example, let's say we're putting street lights in a particular neighborhood or improvements in a particular neighborhood, and we will assess just those property owners that benefit from that capital improvement. And then capital leases, and we're not going to say a whole lot about leases in here tonight. When we get to chapter 6, I'll dig more into the accounting for a capital lease since there's a debt component associated with that. And I think it's better covered in the debt service fund discussion than in the capital project fund. But I took a little bit of a look at the um, annual comprehensive financial report and did see some discussion of leases. So I know that the city does engage in some lease type activities as well. So we'll get into that though a little bit more, I think, after our exam in chapter 6. Okay, good. Now, capital assets are generally acquired by the general fund, special revenue fund, if they have some sort of activity that is funded by a special revenue, then they might acquire equipment for that activity. Capital project fund is where we're going to spend most of our time tonight. Now, remember, our governmental funds include our general fund, our special revenue fund, our capital project fund. Debt service fund typically is not going to be doing a lot of capital asset accounting, so we won't really be contemplating the debt service fund for the construction acquisition of capital assets. However, they certainly would be involved in the financing of debt and the service of debt service fund, the service of debt that is incurred in the construction or acquisition of capital assets. So they're involved, but they don't typically have capital assets in and of themselves. And then we won't talk much about the permanent fund. Generally, that's certain resources that are going to be provided in which we will use the principal to run an activity and or we'll maintain the principal and we'll use the interest to actually run that activity. So there's not typically a lot of capital assets associated with that. So we're really contemplating these three funds here when we're talking about capital assets and capital projects, and capital project fund is really going to be emphasized here. Okay. Okay, good. Also, the funds in the capital project fund are typically restricted for a capital project. So we're saying the capital project fund. There would probably be several capital project funds for the various, various capital project funds for the various projects that an entity would have going on, a city, a county would have going on at any point in time. Okay. Now we followed the historical cost principle. Okay. And so GASB tells us the historical cost, whatever the invoice was, any cost to place the asset into use. If we had to affix it to a certain building or something in order to use a particular piece of equipment, let's say, then that cost of installation would be part of that capital asset. If an asset is donated to us, we would use the fair value on the date of the gift. Okay. General capital assets, we will record them at the government-wide level. Okay, and there are governmental activities using full accrual accounting. We will depreciate at the government-wide level. And they say generally because if we do have infrastructure assets, as you can see here, we do have the modified approach available in which we don't have to capitalize infrastructure assets such as roads, bridges, and we don't need to, we need to capitalize them, but we don't need to depreciate them. And I think Carmen has told us a number of times that in fact, San Francisco has elected to go ahead and depreciate infrastructure assets such as roads, bridges, that sort of thing. And then sort of along the line of what I was saying with the potential donation of library books, works of art, historical treasures, those may or may not be capitalized at the discretion of the governmental unit. So just taking a look on that point, and I lifted this straight out of GASB standards here, and you can see what I've highlighted. I'll just read it for you. Governments are encouraged but are not required to capitalize a collection, whether donated or purchased, that meets all of the following conditions. The collection is held for public exhibition. It's protected and kept unencumbered, cared for, and preserved. You can't just be letting the thing crumble to dust. You know, they give you one of the original 49ers, you know, mining pans or something, and you just let the thing, you know, deteriorate. You have to maintain them and are subject to organizational policy that if one of those items are sold, then you have to use those proceeds to acquire other historical treasure works of art. And if all of those criteria are met, then the governmental unit does not have to record the value of infrastructure assets on their financial statements. So I went ahead and I think I searched on historical treasures or something of that nature and was able to find on page it is the PDF page, and that correlates to page 48 in the comprehensive annual financial report. And where did I see it? Really, you're really gonna do this to me? It was there. Oh, not 148. I can't read my own writing. Page 62. Let's try that. Okay, and some discussion of capital assets. I promise you it was there this morning. Page 62, I'm saying, so maybe it's more towards the top of page 62.
Oh, hi, it's Carmen. You actually come down again. You just passed it. It's just a little paragraph of
Oh, here it is. Thank you. I was looking for a heading and I guess it wasn't there. So thank you, Carmen. But you can see here, thank you. Works of art, historical treasures, zoological animals held for public exhibition are not capitalized. So that's the policy of the city, right? Is that consistent with what your understanding is, Carmen?
Yes.
Yeah. Okay. All right. So they've taken that option. I would imagine most government entities would. I mean, it's pretty hard to, you know, measure the value of a pitchfork that was used, you know, to start up something. And so it's probably a little more straightforward to just not capitalize those, or how do you depreciate something like that? That would be the other issue. So, okay, good. Let's go ahead then and come back. Hopefully my computer, they go through that silly process. Okay. And let's take a look at the modified approach. Now, again, San Francisco does not use the modified approach. Modified approach says for your infrastructure assets, roads, bridges, waters, things that are part of a system, highways, water systems, lift stations, all of that kind of stuff are infrastructure assets, and government could choose not to depreciate those and then use the modified approach as long as they meet the requirements that you see here. And they'd have to have an up-to-date inventory of eligible infrastructure assets, do a condition assessment. And with a condition assessment, a government will literally have to go through its infrastructure assets, and it's things like there are 10,000 miles of road in this city in good condition, 5,000 miles of road in fair condition, 2,000 miles of road in poor condition. Almost sounds like a country western song to me. Okay, so condition assessment and an estimate of the amounts that need to be expended to maintain that condition assessment versus what the government is actually spending. Okay. And then this information needs to be provided in a RSI, required supplemental information, where you can literally go and see what the government is spending versus what it needs to spend to maintain the condition assessment, et cetera. And then they tell us here that they also have to have a asset management system that allows them to do that. And I find it interesting that an accounting standard calls out a system, an accounting process to achieve what they're talking about doing here. And I have a feeling that in the AICPA, the American Institute of Certified Public Accountants, typically doesn't weigh in when FASB or GASB issue an exposure draft for a new standard. They have the position that if GASB asks for it, FASB asks for it, they'll figure out how to audit it. But I would imagine this information that they're talking about here, the auditors might have weighed in and said, you really need to have them have a system so that we have documentation and something to audit. So it's unusual to see documentation and asset management system requirements in an accounting standard, but that was the case here. I was surprised when I've looked around, and I didn't do an empirical study, nor have I tried to get to the bottom of how many governments use the modified approach, but I don't see it much when I look around and just sample around at different comprehensive annual comprehensive financial reports. I'm seeing that most governments choose not to use the modified approach, just in my little, what would you call it? Not even empirical, just my anecdotal look around at different entities. And again, Carmen, you're saying that San Francisco has chosen to record depreciation for their infrastructure assets and not use the modified approach. Is that correct?
Yes, that's correct.
Okay, good. So I don't see any reason for us to belabor this much, since it's something that I don't know how often it's used, and it's something that the city doesn't use, and I wouldn't be asking any questions about the modified approach, okay, in an exam type situation. Okay, good. So let's just take a look and get started here with a very easy example. Purchase of equipment, as we've been saying for some time, under the modified accrual accounting. The current financial resources measurement focus, right, for the general fund. Long-term assets are not recorded. Therefore, if there's acquisition of a long-term asset like this office equipment, I don't know what it is, a printer or whatever, there would be a debit to expenditure and a credit to cash in the general fund. If we were simultaneously recording transactions for the government-wide purposes, okay, then we would go ahead and debit equipment and credit cash for our government-wide governmental activities column reporting. Okay, and again, and I know I keep saying this, we would probably just record at the fund level. I think we've confirmed that the city does that. And then later, and we'll talk about that process and have some examples later in the class, but the government, when they go to prepare their government-wide statements, would make some adjusting entries to convert and consolidate from the fund level to the government-wide level. But we're going to show you both levels of journal entries here tonight. Okay. Okay, good. A capital lease. And again, we'll talk more about leases in chapter 6, but just a very basic, quick looking at how the leasing of an asset would be recorded both at the fund level. And in this example, they're saying, hey, it's the special revenue fund. They're leasing some equipment. And because we don't record equipment using modified accrual accounting for our special revenue fund, again, another governmental fund, we would debit expenditure and credit. And again, because there's no long-term debt, but remember, when you issue long-term financing, okay, like a bond, a lease agreement is long-term financing, you credit other financing sources, okay, which again is reported on our statement of revenues, expenditures, and change in fund balance. Remember, that's that lower part. I sort of say they're kind of like non-operating revenues, non-operating expenses. You report them in the lower part of the statement of revenues, expenditures, and change in fund balance, right after that line item, excess deficiency of revenue over expenditures, where we have more of our operating items. And we continue down with other financing sources and uses. That's where that 50,000 would be reported as an other financing source. Because again, a capital lease is considered a long-term financing, just like a bond is. Okay. Now, at the government-wide level, since we're using full accrual accounting, of course, you record the equipment and you credit capital lease obligation payable. That's a what? That's a long-term liability, yeah, because we're at the government-wide level, so we would go ahead and report. Now, LT is the long-term liability. Okay, we're not going to say too much more about accounting for leases at this point. We'll get into that more later. If an asset is disposed of, okay, then what's going to happen? Well, if you disposed of something and you sold it for scrap for $500, since you never had a capital asset reported at the governmental fund level, say the general fund, you would simply debit the cash and credit. And I've seen different treatments of this, and I don't know if you all have dealt with this, but I'm going to throw the question out there. Here, they're crediting other financing sources, proceed from the sale of assets. I've also seen some literature that would indicate that this would be an other revenue. Does the city have a approach that they use here? Any of you work in capital project stuff? Have you sold a asset for cash like this? Okay. So either I think would be appropriate. You could call it other revenue. You could call it other financing sources, proceeds from the sale of asset. And maybe we'll have some time towards the end of class. I didn't think to do it when I was looking at this slide, but we might be able to look into the annual comprehensive financial report and see if we see any indication under the significant accounting policies, the nature of how a transaction like this might be recorded. Or maybe we look for other financing sources and see if this is listed as something that would be counted as such. But if we're at the government-wide level, now you're full accrual accounting. So you do what? Since you're disposing of the asset, we assumed it was fully depreciated here. You would debit, I guess there's no salvage value, so you would debit the accumulated depreciation for the original cost of the equipment, and then debit the cash for the cash to receive, and you would literally report that as a gain on the statement of activities at the government-wide level using full accrual accounting. So very different treatment for how we account for the acquisition of capital assets and then the disposition of those. under modified accrual at the fund level versus full accrual at the government-wide level. Okay, capital project funds, you do have general, and we're going to kind of go through an example of that in some detail here. For example, building, say a public building like a county courthouse, let's say, is an example that pops into my mind all the time. You also have special assessments. Okay, special assessments are things, for example, the little graphic here, street light. You're going to put some streetlights in a particular neighborhood. Only those in that neighborhood are going to benefit from that. So you will have a special assessment and a tax for that particular thing that's being installed, and only those individuals get taxed for that. There's two treatments, and I think when I looked, I can't remember what I saw for special assessments. Maybe you can tell us how you treat them. For special assessments, there's two places that activity could be accounted for. It could be accounted for in the capital project fund itself, where the for which the special assessment is the construction of that is being accounted for. And that's the case if the government is potentially primarily liable for any bonds or revenues that were generated, bond revenue, let's say, that was generated by for that construction of that asset, or if the government is not potentially primarily liable, it would be accounted for in a custodial fund. Anybody have any examples or indications as to where San Francisco falls in that continuum? Is they typically in the capital project fund for special assessments, or would it be done in a different fund, like a fiduciary fund, like a custodial fund? Okay, both are available, so I'm not sure what we use, and again, that might be something we can research too. Okay, good. So what we're going to do here is go through an example of a capital project. Okay, and we're going to be doing the accounting in the capital project fund, and we're going to be the accounting at the government-wide level. Now, I want to see what makes the most sense for how I want to do this. I just thought I was going to do one thing, but I just thought of another way to do it. Yeah, I can wait here. So, what makes more sense? I think I'm going to do it this way. I'm going to keep T accounts going for this. As we go through, because I find it easier to just sort of follow the whole process if we actually have T accounts that as they show us, and I'm just going to T account the capital project fund, not government-wide, it's not necessary. Just for the capital project fund, I'm going to go ahead and do T accounts just so we can sort of track how this would work its way through as the project is started and as it is completed and wrapped up and closed out. I think it's easier to see all that if we have these back and forth. Unfortunately, now you're going to say, I'm getting seasick here. So I'll try to go as slowly as I can as I go through these different ones. Okay. So we have a situation where we're going to be building a, city office building, county courthouse, whatever it is. And as I was saying, a lot of times the federal government, at least they used to, will go ahead and kick in some money for this. And the federal government, this idea, and I'm just going to make a statement here. Maybe I shouldn't, but I'm going to anyway. This idea that you would take a chainsaw and hack away things from the federal government, and somehow that would have a rippling effect throughout the economy. The federal government spends money, and that helps drive economic activity, particularly if you're in a recession or something like that. The spending of federal resources is something that can help get a economy that's maybe in recession into recovery. And so to walk around with a chainsaw and act like, you're saving the world by doing that could have, I'm not predicting, I'm not an economist, but it certainly could have recessionary implications. For example, I saw something, and I don't know if it's true or not, that Stanford University now has instituted a hiring freeze, and they're doing that because they're not sure about federal funding going forward. And so that's the kind of thing that I'm talking about, that, we start to have a hiring freeze and whatnot, slowdowns in the economy, and all of a sudden you find yourself in a recession. And if you just handcuff the government by, shutting down a bunch of things, how do you get yourself out of that trough? So I don't know. Okay, just my own personal thoughts, and I'll shut up because I should shut up. So, but in this particular case, as has been the case, the federal government is going to be providing some funding. And so we're going to go ahead and set up this due from the federal government. Now, due from is like accounts receivable, but often when money's going to be coming from another fund into, say, the general fund or capital project fund, or if money is going to be coming from another government, we'll use due from. If we owe another government money, remember we looked at the payroll stuff last time, and we owe money to another government or to another fund, we often use the term due to, due from, due to, as opposed to accounts receivable, account payable, but sort of keep it in your mind as to that's what these are. So you take a look, and I teed up cash, but let me also tee up here due from Fed, and I believe that was 100,000. And then we also had revenue, and we credited that for 100,000. You see where I'm going, guys? I'm trying to tee these up so it's easier for us to kind of see how these transactions would work their way through the accounting system. And I'm only going to do it for the capital project fund. I'm not going to do it for the government-wide. Government-wide, very similar entry with just more different titles as to what you would show at the government-wide level, but due from and revenue account being credited. Okay. Remember, we had our program revenues. We had the different types of program revenue. One was contributions, right? Was one of the sources of our program revenue. And those program revenue, remember, we saw in the statement of activities, are used to defray the cost of various programs, and then we would show the net expense of those programs, and then the expenses, the revenues were on the bottom of that statement of activities. Okay, so that would just be the journal entry to allow us to prepare those financial statements. Okay. All right, good. Let's go ahead then and see if I can still click over this mode. Yeah. Then we go over, and we need to get some blueprints, whatever, architectural design. And so we're going to need some money to pay for this. And so we go ahead and we get some cash in, and this cash is coming from our buddy, the general fund. And it's expected, this is a reciprocal transfer. In this particular case, it's expected that we'll pay them back. So we'll set up interloan fund payable for 50,000. Okay, so I'm going to go back. Okay, this is what I'm saying. Please don't get seasick as I keep flipping back and forth here, but I'm going to debit cash for 50,000. And for cash, I think I'm going to keep a balance because there's a lot of transactions that hit the cash, and I think it's easier for us if we have a balance here. Okay, 50,000. And then over here, I'm going to credit loan, fund loan, whatever, for 50,000. Just posting that up. Okay, all right, good. Now we come back to the slides. Okay. And no entry is needed for interfund activity at the government-wide level. Okay, so we just go over to now the encumbrance for that, and we go ahead and say, hey, construction company, 50,000 for the blueprints is what they're thinking they're going to charge us. So we just go ahead and encumber that. Okay, so we debit encumbrances, we credit budgetary control. Remember, we talked about encumbrance process last time, and when you order goods and services, the government is going to use encumbrance accounting for that to make sure they don't overspend their budget authority. And so I'm just going to go ahead and set up my encumbrances. We debited that for 50,000. Let me go ahead and I'll put over here. Budgetary control, remember, is the thing we always credit there, right? So I'm just going to go ahead and credit bud control. For 50,000. Okay, all right, good. So we went ahead and we encumbered for those blueprints, whatever they are, and then we go ahead and no encumbrance entries are needed at the government-wide level. And then we come over and we get a bill for 48,000. Okay, we thought it was gonna cost 50, it cost 48,000. No big deal. Okay, all we do is we reverse the original encumbrance entry, okay, by debiting budgetary control and crediting the encumbrance. Now, the actual cost on that was 48,000. So let me go ahead and debit expenditure. Remember, we're in the capital project fund for 48,000. And credit the cash that they paid for 48,000. And so now we've got $2,000 of cash left in there in the balance. Okay, and then at the government-wide level, okay, we would go ahead and debit construction work in progress. That's an asset. Full accrual accounting. So construction work in progress is like an inventory account of things that are being constructed. Then ultimately, once the thing is done, we'll transfer those costs that we recorded in construction work in progress into the building account or whatever it is. You know, if the project wasn't completed by the end of the accounting period, then we would report as an asset construction work in progress. So it is an asset account. Okay. Okay, good. Now you come over and you take a look, and hey, we need more than $2,000 to build this building. And so we're sitting there and we say, well, we want to issue some bonds for 5 million, and the bonds are issued at a premium at 101. And so when you see that, you would take the 5 million, right, times 1.01. And that's how they come up with this 5,050,000 that's going to come in to the capital project fund. Okay. Now, the way they did this, they put the long-term proceeds as an other financing source for the principal. For the face, for the premium here, they just set that up as due to the debt service fund. Bond covenants generally read that any money that would come in on a premium or something like that is to be used for the protection of bondholders. And so the expectation would be that you send that over to the debt service fund so that they have $50,000 now to start to accumulate for the payment of principal and interest. I have seen other literature that would suggest that the capital project fund would all report this as another financing source in the capital project fund, and then per the bond covenant, transfer that money out of the capital project fund into the debt service fund. Carmen, does San Francisco have a particular way that they would handle something like this? Well, let me ask two questions. Do they typically issue bond at premium? I think most governments do, so that would be a curious question. And how is the premium accounted for? Is it like this, or do they set up another financing source and then later transfer that money to the debt service fund? Or I've also seen where only the face amount is accounted for the capital project fund, and in the debt service fund, they will simply debit cash and credit other financing sources, and the money never hits any sort of accounting in the capital project fund.
So the first question, yes, we frequently have premiums and sometimes discounts. But yes, premiums. And ultimately, yeah, they would be accounted for the debt service.
Right. Do they
Yeah,
run through the capital project fund, do you know, or do they just go straight to the debt service fund, the premiums?
I actually don't remember at the moment. I don't
That's
work
okay.
on it myself, but yeah, I can certainly find out for you.
It's okay. If you have a moment and it pops in your head or something, that's fine. But those are the options. Okay. And
Yep.
the book is saying, hey, they're going to set it up as a liability due to the debt service fund. Okay, so we'll roll with that in this example. So let me go back though to my little ledger here. Okay. And the cash account now has where did I put that? 5,050,000, which brings our cash balance up pretty healthy, right? 5,052,000. Okay. And let's go ahead and set up that liability. I'm going to kind of stick it down here. Due to DSF is going to be debt service fund for that 50,000. Okay, so we teed that up. We've got this 5,052,000. So we got a good chunk of cash. Now, I don't think you could build anything for 5,052,000, the size of a city building, but that's okay. And then let's go ahead and look back at that journal entry. Yeah, we got the cash, right? 5,050,000. And at the government-wide level, we would use full accrual accounting. So you'd set up that premium. If it was a discount, that means it would be less than face. And so what we would be doing there is just debiting the cash for the less than face, creating the bond payable for face, and then debiting the discount for the difference. Okay. All right, good. Let's go ahead then and let's take a look. And remember, the federal government said they were going to send us some money. So they send us this money. And so we go ahead, and in both levels, the entry would be very similar. And so we go ahead and this debit some more cash. What was it, 100,000? So now we've got 5,100,000.
Oh, where did the 100,000 come from?
1 second, I'll show you right now. 1,152,000 is the cash balance, and it came from the federal government.
The federal grant is 100,000?
Yeah, isn't that what it said? Did I put 1 million down there by accident? I think it's 100,000. Let's see. Yeah, 100,000. So we had set the grant up. Where is it? Here. So the federal government said, hey, congratulations, you've been approved for this money. Right? So using our revenue recognition rules, I'll just assume this is a voluntary revenue that we received from the federal government. So we've been informed that we're now eligible, and they don't put any time constraint on it. So it doesn't have to go through deferred inflow. And so it goes straight to revenue, right? And we set up the due from. And then a little bit later, they send us the money. So we debit cash and credit the due from. Does that answer the question?
Yes, thank you.
Okay, yeah, sure. Okay, all right, good. All right, and then we just post that up there. Okay, so we got a good chunk of cash now, so I think we're going to start to spend some of that money, if I recall this example. And so we go ahead and, since we have money in the general fund, remember, we had that interfund loan payable for 50,000. So we go ahead and we're going to send that money over to the, I guess it was owed to the general fund. So the general fund is going to debit cash and credit what they would have set up as the due to. We're just doing the accounting for the capital project fund here. So we're going to debit that payable to liquidate that and credit cash, of course, because we're sending some of that cash over. So we're simply just giving them their money back. So when we take a look, that interfund payable, we can now debit it for 50,000. That closes that out. And of course, we have to credit the cash for 50,000 because we're sending them that money now. And now our balance, and forgive me for being such a nerdy accountant, guys, I have to do this or I can't sleep at night. 5 million, right? What is it? 102,000 now? Okay, and we've paid that loan back, and then we don't make any entry at the government-wide level for interfund activity. Okay, all right, good. Then what? Now we sign the contract with the construction company to build the building, and we sign it for 5,050,000. Okay, so we go ahead. We have to use our encumbrance accounting in the capital project fund. So we go ahead, like we learned last time, we debit encumbrances for 5,050,000. We credit the budgetary control for 5,050,000. Okay, all right, good. So we got that covered now. And of course, we're going to probably start getting some progressive billings on this thing from the construction company. So let's go ahead. Don't have to record encumbrances at the government-wide level. And yeah, they go ahead and they bill us for 3 million. Okay. And so we go ahead and we debit the budgetary control now for the originally encumbered amount for that, which was the 3 million. Still have some more to go on this. We're not done yet. We credit the encumbrances for 3 million. The building isn't done yet. Okay. And then we're going to go ahead and set up this contracts payable. Sure, and leave myself enough room there. The cash gets a little complicated. So let me put contracts payable down here. We're going to pay these guys eventually. 3 million. And we debit expenditure for 3 million. Again, we're in the capital project fund on this page. We're just teeing up the capital project fund in this example. Now, when we take a look at the journal entry again for government wide, okay, so there's my construction expenditure, 3 million, contract payable. We reverse the budgetary encumbrance entry. At the governmental activities level, we'll still have a contract payable using full accrual, but we debit, not expense, not expenditure, a balance sheet account, an asset account called construction work in progress, construction in progress. It's an asset. If the project ended and we weren't done with it yet, then we would report that as an asset on the balance sheet. Okay, in this example, we're going to finish presumably the whole project within the accounting period, and that won't be necessary to report out construction in progress. But if that were the case, we would report that for the items that aren't completed yet. Okay, all right, good. Now, what this example does, and I'm going to kick out a question here about how the city handles these sort of things, but we don't pay the invoice in its entirety up front in this example. We say, you know, we're going to retain 150,000 of this, 5% of this. We'll pay you 285, but we're going to retain 150,000. Now, the reason I would do this if I was having, say, some work done in my backyard or something, you know, I've always instructed contractors that I use to, you know, do some landscaping work and stuff in homes that I've bought over the years, is I tell them, hey, look, you know, you can do progressive billings on me, but I'm always going to hold back a piece of any amount that I pay you in case we get to the end of the project and something isn't up to specification, then, you know, I'm not going to pay you that full amount until any issues are corrected. And, you know, you would have that in writing in the contract. And so I'll insist that that go in writing in the contract. And sometimes you'll have, you know, some guys that don't like that, whatever. But, you know, that's something that I recommend in any kind of long-term project like that. Is that something that the city does to sort of protect themselves in case there are some things that aren't quite up to snuff that you can hold back from a contractor?
Yes.
Mhm. Yeah, it's just the nature of things. If you don't do it, you're going to be sitting there with things not to your specifications and no way to kind of hold them accountable. So that's what we're doing here. And so we go ahead and we debit the contract payable for the full 3 million. Credit the cash. Somebody help me out. What was the amount? 2 million. So I don't have to flip back. 850,000.
Yeah,
Thank you. And that brings my cash balance now to two 52000. Okay, that's that credit. And then I'm going to set up, which is essentially a liability, this retained percent, whatever. And that was 150,000, right? Guys, forgive my writing. You know, for an accountant, I have some of the sloppiest writing. Most accountants are pretty neat, right? I'm not. I never was neat when it came to writing. The teachers used to send letters home saying that kid can't stay in the lines. Okay, so I never have been good with my penmanship, so forgive me on that. And then as I've gotten older, my neuropathy gets worse and worse. And then you add the fact that you're writing on a tablet, so forgive me that my writing is not great, but you kind of are following along from the slides, I think, how this is, what these different accounts are. Okay. Okay, good. Government activities, government-wide, same entry. Okay, good. Then what? Then we go ahead and we get the final bill. Okay, and when we get the final bill's for 2 million. Hey, we've now spent 5. We encumbered 5,050,000. That's okay. You reverse the encumbrance for what you had originally put in there, and at that point, since there was only 2,050,000 left in the encumbrance, that's all we have left to take out of there. Okay, because we'd set it up for that total 5,050,000, but now we're only spending 5 million on this. So we just go ahead, no big deal. We close out the encumbrance now because we've got the final bill on this. So we go ahead and credit the encumbrances for 2,050,000. That closes that out. And we go ahead and debit budgetary control for 2,050,000. That closes that out. Those are both zeroed out because we're done, being billed for this thing. So we don't need to sit there. That line is the balance showing that those are both zero, which I think you can eyeball that and see that it's a 0. Okay. And then the actual expenditure for that, as the slide indicated, was what? 2 million. So we debit the 2 million. We credit the contract payable for the 2 million. Okay. Don't get seasick, guys. Okay. Debit the expenditure for 2 million and credit the contract payable for the 2 million. The encumbrance entry isn't at the government-wide level, but at the government-wide level, we would set up the work in progress and the payable, right? Okay. Then, just as we saw before, we're not going to pay that whole amount. We're going to have on that bill, we're going to have a retained percentage. Okay. Okay, so we go ahead and we pay him 1.9, holding back 5%. We put 100,000 in the retained percentage. Okay, so we go ahead and we debit now the contract payable, 2 million, because we're paying that, at least that particular liability up. But now we're setting up a liability for what? The 100,000. And we're actually paying them in cash 1,900,000. And so now the balance in my cash account is down to 352,000. Okay. All right, good. Now we come over and we have our engineers, same entry at the government-wide level. Then we have our engineers look and say, okay, yeah, it's fine. Go ahead and pay the rest of the contract. There might be some minor things that have to be done that we might use our own construction folks to tweak a couple of things. But we go ahead and we pay off the contractor. So if that's the case, now we can go ahead and debit the retained percentage payable. Okay, so we go ahead and debit that for the 250. I guess I should, just to be perfect, I guess I should write that down a little lower. 250,000. So that closes that out. They're all paid off now. That's a 0. Yeah. 250,000. That zeroes that out. I guess that's not looking that one too, but that's all right. 250,000. Now the balance in the cash account is 102,000. Okay. And now you look, and for some reason, okay, oops. The 102,000 that's left in the cash account, and for some weird reason, I don't know if it's weird or what, some sloppy reason, the book never paid that money that was due to the debt service fund. I'll handle that for them, okay? They never put together a journal entry that would pay the 50,000 for the premium they had to go over the debt service fund, but I'm gonna send it over there. Okay, so let's go back and let's do that on our little chart of accounts here. So I'm going to take cash out of the capital project fund cash. So I'm going to credit it for 50. Okay, and I'm going to go ahead and I'm going to pay off that debt service fund loan. Okay, so now at not the money that we owed, it wasn't a loan, but we owed it to the debt service fund. So now I'm left with 52,000 sitting in here in the cash account. Okay, so we're left with this balance here of this 52,000. Let's see how we're going to handle that 52,000 through the closing entry process. Okay, so that's what we see next as we go to close out this capital project. Okay, so we have to close all income statement accounts, all proprietary accounts, all the accounts that will appear on our statement of revenues, expenditures, and change in fund balance. They all need to be closed out. Okay, so we go ahead and we want to close the revenues. We want to close the other financing sources. So we do that. Did I forget to put the other financing sources? I sure did, didn't I? Yeah. When that money came in, so let me close the revenue 100,000. But when the money came in for the bond, and I forgot to tee it up, guys, I'm sorry. When the money came in, let me go back to the slide where the money came in. Long-term debt financing, okay, because I think I got all hopped up on talking about the premium and all that, and I forgot to tee up the other financing sources, bond proceeds for the 5 million. Okay, they would have credited that. When you have long-term debt, that's another financing source. We've talked about that. Okay, and so I just forgot to tee it up. So I'm going to tee it up now. I'll put it down here, I think is fine. Other financing sources, bond proceeds. Needed to be credited for 5 million. And I set up the due to the debt service fund at that time, and then I had debited cash at that time for the full 5,050,000. Now I'm simply going to close this account. And I have to close it because it's a proprietary account. It shows up on the income statement. It shows up on the statement of revenues, expenditures, and change in fund balance more specifically, more accurately. And so you see that now going back to the closing entries. Wonderful, I'm going the wrong way. Speed reading here. Okay, now going back to the closing entry, I debited the revenue to close it. I debit the other financing sources to close it. So that's closed. And then I close my construction expenditures, which have 5,048,000 in there. So I go back. And right now my construction expenditures are showing 5,048,000. I want to close that to 0. Okay. And then I need a credit to make this journal entry balance. And that credit is for 52,000. That makes the entry balance. And I'm going to put that into my restricted fund balance. Most of the fund balance in your capital project funds, it's all going to be restricted. Okay, now you could, in a weird circumstance, maybe have a negative unrestricted fund balance, but there will always be a positive restricted fund balance sitting in that capital project fund. And so I go ahead until the project is closed. And so I go ahead and I credit this restricted fund balance. So come back. And I credit that for 52,000. And that now closes all of my proprietary accounts, all of my income statement accounts, and now I have this fund balance of 52,000. I have a fund balance of 52,000, and I have what? And I have restricted cash of 52,000. So it's not like, the city managers can go to Las Vegas on this money or something. The bond covenant will probably read, because most of this money came from a bond, any monies that are not used in the construction, this 52,000, will be sent probably to the debt service fund. So that's what we're going to do. We're going to take that 52,000 and we're going to send it over to the debt service fund. Now we paid back the loan that was due too. We already paid that, and the book never showed us that, but I wanted to clear that up. So we did that. But then the 52,000 that's sitting there, that's restricted in the capital project fund, it's either restricted for the construction or for the protection of bondholders. So we're going to send it to the debt service fund. Okay. So we go ahead and going over back to the slides, we debit other financing uses, transfer out. We're sending the money out of the capital project fund to the debt service fund. Okay. And so we go ahead and we debit now. And again, this would show up on the statement of revenues, expenditures, and change in fund balance. We had what? We had long-term debt proceeds as one of our other financing sources. We have what? Our one other financing use, which is transfer out. Okay. And so we go ahead and we tee up, just to have a complete set of T accounts here. I don't know that it's necessary to tee it up for illustrative purposes, but let's do it. Okay, we have other financing use, transfer out, 52,000. We credit the cash for 52,000. All right. And then because other financing uses is reported on the statement of revenues, expenditures, and change in fund balance on the income statement, it is a proprietary account. We have to close it. So we go ahead and do that closing entry, which is to credit other financing uses, interfund transfer out, and debit the fund balance for the 52. When we do that, going back to our T accounts. Okay, we credit the other financing uses, 52. That closes that. And we debit the fund balance. That closes that. This capital project now is done. It is completely closed out. We've closed everything out in the capital project fund. Okay. Everything is 0 now. Okay. And we go ahead and in our governmental activities, I probably should have shown you that earlier. we take all of those amounts that were being accumulated in, well, we close out. Where'd that go? Where did they do that? We need to take it out of construction in progress and put it into building. Here it is. We take everything out of construction in progress and put it into the building account, out of one asset account into another. And then we would proceed to depreciate this asset as we move along from period to period now that we have placed it into use. Question.
Oh, I have a question about the interfund account for the on the general fund loans. So the 50,000 that is debited, we did that when we use our cash to pay back the general fund. Is that when we
To pay back the yeah, the general, did I say the debt service fund? Yeah, I'm sorry. To pay back, was it the general fund that loaned us the money? I guess it was, huh? I said debt service fund. You're right. I set it up as due to debt service fund, and I should have set it up, thank you, as due to general fund, because I think the slide said the general fund had loaned us the money. So when the money came in, right, I credited due to general fund, I debited the cash for 50,000.
okay?
Oh, no. Well, no. I did it right.
Huh.
I'm sorry. That 50,000. They had two 50,000s there. The first 50,000, which they did show us paying back, did I set up a due to general fund for that though? I didn't. That first 50,000 that came in, okay, what I should have done, yeah, is set up. Thank you for pointing that out. I should have set up when the first 50,000 came in, I should have set up due to general fund for 50. So that's how that money got into the cash account. Let me just go ahead and number that as journal entry 1 there. Okay, and then, and the book did show me that a little bit later on one of the slides, they paid that 50,000 back. So we credited cash and we debited. Come on, John. I've only, been doing debits and credits for 40 years. I credited due to the general fund when they got the money. Then when they paid back, I of course credited the cash and I debited due to general fund. That was that 50,000. This 50,000 that I did, that one the book never showed us that, and I'm just going to go ahead and label it number 4. I know it's not the 4th thing, but just for what we're talking about, I credited the cash and I paid off the amount that was due to the debt service fund. So I forgot to tee up the general fund is all that happened. Does that answer the question?
So the 50,000 debit to the interfund was to pay the debt service fund?
The 50,000 what?
The interfund T account, there's the 50,000 that's debited.
No, the interfund transfer.
Oh yeah, interfund, yeah.
Yeah, that was this 52,000. Because after we closed all the accounts, right? Just to picture the balance sheet after we had closed everything else, we had cash of 52,000, right? And we had restricted fund balance of 52,000. That's the balance sheet. Okay. Now, what are they going to do with that money? The project's done. What are we supposed to do with this 52,000? We built the whole building. We're satisfied. We paid the contractors. We got a brand beautiful building sitting up there. What are we supposed to do with the 52,000? Well, the debt covenant often reads that that money in the capital project fund needs to go over to, do it this way, to the debt service fund. Okay, so what we did is we went ahead and debited other financing uses, transfer out. That's reported on the statement of revenues, expenditures, and change in fund balance. We credited the cash. That closed out the cash. The cash is now zero. And then we have to close out our proprietary accounts. Other financing sources is a proprietary account, and closing entries, you have to close proprietary accounts. So since we had debited it when we set it up, right there, we have to credit it to close it out, and we debit fund balance. And when you do those entries, now the cash is zero and the fund balance is zero, right? And the project is completely closed. Mary?
Yes. Okay, understand the 52,000 closing.
Was that what you were asking about? Was the 52,000 the transfer out, right? There's only one transfer out in this example. That was when we transferred the cash out, right? Out of the capital project fund and into the debt service fund. Now, debt service fund now, ignoring the first 52,000 we said over there, they'll have 52,000 in cash, and they'll have a restricted fund balance of 52,000 because they got that money. They actually have 102 because we also sent them 50,000 for the premium, but I'm not going to bother with that right now.
Okay. I wanted to go back to the 50,000 that we borrowed from the general fund.
Mm-hmm.
So okay. So when we first borrowed the 50,000 from the general fund, we debit cash and credit the interfund.
No.
No. We don't credit the interfund. No.
It's not. It's a loan though. It is. I think they did use the term interfund, but it's not a transfer. It's a loan, so it's a liability. So when we first, they did call it interfund loan payable, but that's a liability. That's on the balance sheet.
Oh, so interfund is a liability account. Okay.
Yeah, on the balance sheet, and then when we paid it, then I debited this liability, interloan bill, right? It's a liability, and I credited the cash, and that paid that off.
Okay, so when we pay back the general fund, then we credit cash, and then we debit the interfund payables.
Correct, and that paid that off.
Okay.
That paid that off, and at that point, then when I went ahead and paid it, because I couldn't pay it right up front because I had to get some cash, right? But once I had some cash, then I paid it. So I went ahead and I debited the interfund loan payable and credited the cash. The general fund was kind of getting me started for the blueprints and stuff until I was able to get some money in through primarily the bonds, and then there was the federal money that came in as well. But once I did that, then I went ahead and I had that paid. And it gets a little confusing because then there's also the amount that was due to the debt service fund when we had issued the bond. So, and the book never showed in the form, general journal form, like they're showing you on the slides, they never showed the payment of that. Just so we're clear on what happened with that 52,000 in the end, I went ahead and I paid it. So we'd see that we had that 52,000. So I paid the debt service fund back the money that not back, but I owed them that money because again, debt covenants often say that if you issue a bond and a premium, you got to kick that money over to the debt service fund.
Okay.
Question.
I one more question. Do you
Yeah.
have a T account for a due to journal fund account or no?
Yeah, I set it up down here at the bottom after I forgot to do it initially.
Is that set up when we receive the money, the 50,000 from the journal fund?
Correct. When we got that money, I debited cash. That was how they got us started, right? Because we had to get money from somewhere. And the general fund, sometimes I hear people say, think of the general fund as the general. It kind of commands everything, right? The general fund, that's what it's kind of like there for. To say, okay, you need some money? Here, capital project fund, go ahead, get started, but we want it back. Okay. And so they got the money, they got it started. And so they debited the cash, they had cash. And they also had at the same time now this liability due to the general fund. Right there. Well, just let me click on just that part right here. Debited cash, credited the liability.
Okay.
Then when I paid them, I debited the liability and credited the cash. That's that number 2, but I labeled number 2. Okay.
Okay. Thank you.
Okay, good. Now, couple more, I think we have a couple more slides, but I'm not going to belabor those points. Oh, we would depreciate the building, and of course, we'd have to pay off that liability, that bond payable. I'm not going to get into depreciation accounting here. I think you all know we depreciated over the useful life, etc. And the liability would be paid off at the government-wide level, both the depreciation and the payment of the liability, using full accrual accounting. And we'll talk about debt service fund accounting next time and how a bond, focusing on term bonds, really, although I know the city has both, but we'll focus on the payment of the liability and term bond when we go into chapter 6. Okay, I think that's enough of the slides. Couple finer points there at the bottom, but let's spend some time before we want to adjourn, and let's look at how you might be tested on some of these things. Okay, so let's take a look right here. That's chapter 6. I'm not going to do that one. So I can close that. And chapter 5. Okay. Okay, good. I'm going to take this. Maybe I'll leave it at top. So let's take a look at this one. Number 1, equipment and general government services that has been acquired several years ago by Special Revenue Fund at a cost of $40,000 was sold for $15,000. Accumulated depreciation of $30,000 existed at the time. The journal entry to be made in the governmental activities journal. Now you would need to know, hey, governmental activities, that's government-wide. So I have to use full accrual accounting. Now, when you get a question, guys, I'm going to go a little bit into test prep mode here. When you get a question where they're asking you, which of the following would or would not be part of the journal entry, your best bet is to make the entire journal entry for a transaction and then go ahead and compare it to the choices, and that makes it much easier. So if they tell me that they sold something for $15,000 cash, the first thing I would do is debit the cash. Hey, if they sold it for cash, they got cash. I'm not going to argue with the question. I'm going to debit cash for 15,000. Okay. And they tell me that they acquired this asset several years ago at a cost of 40,000. Well, if that was the case, then they must have, using full accrual accounting governmental activities, debited equipment for 40,000, I guess credited cash at that time. And so now they're getting rid of the equipment, so they're going to credit the equipment. Okay. Then if I get rid of the equipment, I have to get rid of the accumulated depreciation. So I would go ahead and debit the accumulated depreciation, 30,000, to get rid of it. Okay. And if I'm sitting here and I have this asset that I bought for 40, and I'm now it's depreciated for 30. That means it has a book value of what, 10. So that means I have what? I have a gain because I sold it for 15. It has a book value of 10. I sold it for 15. So that's a gain of 5,000. That would be the journal entry that you would make at governmental activities for this transaction. Now, once you go ahead and you have these journal entries here, then you look and you say, well, no, because they're saying what would not be part of the journal entry. Yeah, cash, I debited cash. I debited the accumulated depreciation. Yes, I did. I credited the equipment. The 5,000, and maybe I didn't need to do that full journal entry. There's no such thing as other not financing sources at the governmental activities, government-wide level. So I could have come to D being the wrong answer, the right answer, because it was not part of the journal entry. You know, at the government-wide level, you would credit a gain. Okay. Okay, good. Stop me if there's a question, guys. Let's take a look at this next one. And they're saying, what would be recorded in the governmental activities column? Now, this really question could have been in chapter 1 or 2. I'm putting it in chapter 5 because it's relating to capital assets, but it really is, hey, do you know activities that are governmental fund or internal revenue service, internal service fund transactions versus what? Versus a proprietary fund activity for just our enterprise funds, our business type activities, or a fiduciary fund activity. And so you have to categorize these appropriately. So and you know what, this question should have been better written. It really should have said enterprise fund, because the reality is that what the internal service fund is a proprietary fund, and it would be included in the governmental activities. The enterprise fund is, of the two proprietary funds, the enterprise fund is the one that needs to go into the business type activities, but that's what they meant. And so that would not be part of the governmental activities. Capital assets used for public purpose trust fund. Public purpose trust fund is one of the fiduciary funds, and it's not even reported at the government-wide level. It certainly wouldn't be in the governmental activities. Capital assets of general government, yeah, that is part of my governmental activities. Okay. Okay, good. In which of the following funds or activities would it not be appropriate to record depreciation? Again, I could have asked this as chapter 1-2 material, but you do not record depreciation at the fund level for the governmental funds. Proprietary funds, fiduciary funds, yes, but any of the governmental funds, general fund, special revenue fund, capital project fund, permanent fund, those do not have debt service fund. those use what? Modified accrual accounting, there's no depreciation. Okay, so the only one that was a governmental fund here was the capital project fund. Now, we would report depreciation on, and in the case of San Francisco, all assets, including infrastructure assets, you would report depreciation on those. Number 6, a city accounts for its capital acquisitions using encumbrance. When the city enters into a contract to acquire equipment, what journal entry should it make? And when you are entering to a contract to acquire the equipment, we saw it several times in the little example there. Debit the encumbrances, credit the budgetary control. Number 7, the following set of facts applies to questions 7, 8, and 9. Sometimes I'll do that, or test preparers will do that, because if you're answering multiple choice questions, this gives it almost sort of more like a task type of thing, because you have to follow a set of facts to answer several questions. So I went ahead and did that with this one, okay? And so I find with some of these, it's often useful to look at the questions that are going to be coming on a one-at-a-time basis before you read through the facts, to see which of the facts might relate to first question, then the next one, then the next one. So this one, they're looking for revenues. So I start to look, is a transfer a revenue? No, a transfer is not a revenue. A transfer is what? Other financing source, isn't it? So that's not revenue. Remember, revenues minus expenditures give us the excess of revenues over expenditures. And then we go down that non-operating section where we start reporting other financing sources and uses. So a transfer is another financing source. It's not a revenue. A grant of $2 million from the federal government? Yeah. In the example that we saw, okay, a grant of $2 million was a revenue. Okay. Bond proceeds? No, bond proceeds are what? Other financing source. So the only thing, where's this other 100,000? Oh, and then earnings of 100,000 from temporary investments. Yeah. We didn't look at that in the example, but the capital project fund, if it, like when it received that $5 million on the bond, let's say it wasn't ready to begin construction really right away, it could put those monies into some very safe temporary investments, not junk bonds like Orange County got into 1 million years ago before you were born. They screwed up and put money into junk bonds and lost their shirt. So now after Orange County, and maybe Carmen, you can help me with this if the city does this, idle funds need to be put into very safe vehicles like treasury bills, certificates of deposit, that kind of thing.
Yes, that's correct.
Right. That came after the Orange County debacle, which I don't know if anybody, probably nobody remembers that. Most governments passed that after that. But this 100,000 of earnings would be a revenue if you have earnings from temporary investments. So yeah, that's a in practice midterm teaching moment. I did not say that as part of the discussion in that example, but that would be a revenue. So you take the bond proceeds, is another financial source, but you take the grant and those earnings, and that's how you come up with the answer. The other two are what? Other financing sources. Okay, then again, using that same set of facts, it says based on the preceding set of facts, how much should be reported as other financing sources? Okay, well, we've already seen that we had what? Change the color up on here, I guess. Let's use yellow for this. Okay, we had the transfer of 1 million, and we had the bond proceeds of 7 million. Both are other financing sources. And so that's how you get the answer of 8 million down here. And then based on the preceding set of facts, what should be reported in the financial statements of the general fund? Well, it tells me that what? The general fund transferred 1 million. So if the general fund transferred 1 million, Okay, and who are we doing the accounting for here in the capital project fund? The capital project fund would have debited cash for the 1 million, would have credited other financing sources, transfer in. They'd also have done it for that 7 million, but to answer this particular question. Now, in the general fund, they're going to credit cash for 1 million because they're sending that money out. And they're going to debit what? Other financing uses. Transfer out 1 million. Okay. And so that's what that was asking, is they were kind of flipping on you on this last question and saying, okay, what about the general fund? What would it report? And it would be what? It would be an other financing use transfer out. Okay. Okay, good. That's it. Okay. So that would be how I might test you. And you can kind of see, guys, how understanding that example was useful towards answering the nature of questions that you would see on a test dealing with this material. Any question? Do you want me to post up that Word file that had all those T accounts on there?
Yes, please.
Yeah, okay. I'll post that up. You'll have that. You'll have the lecture. I'll post that all up under Chapter 5. Start to take a look at some of the stuff, guys, because I think it'll be helpful. The practice exams for Chapter 1, 2, 3, 4, and 5 now. I think that'll be useful. And what I'll be doing prior to next week's class, I'll post up at least one practice midterm that we'll go through together, and it'll have new set of questions from all 5 chapters, questions you haven't seen before. We'll practice with that. And then on the day of the exam, and I'll talk to you more next time about exactly how we're going to do that exam. Either you're going to work individually, or if I can figure out how to do groups in Zoom, then I might assign you to groups and do it that way. Okay. Questions, guys?
Oh, I have a question. So for next week's class, we are just gonna do practice. And in the
Correct.
practice, we're just gonna go over questions for the whole class, in the whole class.
Correct. Yeah,
Okay.
I'll probably put together an exam of 30, a practice exam of 30 questions similar to these, but they'll be from all 5 chapters, and we'll just go through one by one. And so a good, exercise for this week would be looking back, until next Thursday, would be to be looking back at the old exams, the ones that are already up there that we've been going through. And that'll kind of pump you up to be ready to go on next week for the practice. And then it's the real deal the week after.
Okay, thank you.
Okay, guys, if there are no other questions, you have a good night, and I will see you next week. Okay, and I'll post that practice exam. I'll have what I'll do is I'll have a module in e-learning called practice exams, and I'll probably put that towards the top so you can see it there. I'll put it towards the top, like right under the syllabus or something. Okay, guys.
Thank you.
Thank you.
Have a good night.
How soon can I get that, professor? Because I'm just afraid that I do not have access.
How soon can you get what?
That you will post the exam or practice exam.
I don't know. We'll assume you will have access.
I'll try to get everything like by tomorrow and Saturday morning because I'm flying
Oh,
out.
no, that's not going to happen.
Uh,
What, are you trying to make me lose some sleep tonight?
okay.
Yeah, no. I'm sure you're not leaving the planet, right? I'm sure you're going to have access to the internet somewhere, right?
At
So
some point, I don't know, maybe because I might able to only access to do it in the hotel. When I out about, it's kind of hard, moving around. but I try my best, Professor.
Okay, well, what hotel in this world doesn't have internet access?
Yeah, that's why I say a hotel, I will get access. But
Right,
other
so-
than that,
So what I'm saying is, where I was going with that is if you, you know, if you can't get into e-learning for some strange reason, which I don't think that's going to be the case, then you can email me and I'll email it to you.
oh, okay, that sounds like a great plan. Thank you.
Yeah.
All
Okay.
right. Thank you.
Okay. Yep.
Good night.
Good night.
Thank you, John.
Good night, Mary. Have a good
Night.
night.